May I request our management committee member Vinod Garg to escort the speaker to the dais and present the floor. It's my privilege to introduce today's speaker, Rani N.R. She is a fellow member of the Institute of Economics of India, over 19 years of experience. She is a partner at G. Ananta & Co., Bangalore, specializing in statutory frameworks for both non-profit and for-profit sectors. Has expertise in international taxation, having a diploma in international taxation from ICAR. She has authored and co-authored books on international taxation and transfer pricing. Also holds a master's in business law from National Law School, Bangalore, and has spoken at various forums on income tax and international taxation. With this brief introduction, I introduce and present before Ms. Rani N.R. N.R. Over to you, ma'am.
Members, at the outset, I thank the Bangalore branch for really giving me this opportunity, because unless this session was there, I wouldn't have started reading this act, to be very honest with you. Especially income from salary, house property. I remember reading salary with so much seriousness in my CA inter days. Now it has just come to we get Form 16, and in our individual tax return, every information is available in Form 16 and about exemptions, computation. So thank you again for giving this opportunity. And thanks to Madam Nirmala Sitaraman. I think of late, at least my experience, we have started or rather lost the skill of reading the basic act. Unless we have a serious interpretation issue, or we really have some fait accompli situation where already the damage is done and we want to get out of the situation, we really read the ifs and buts of sections. Otherwise, at least our generation, the people I am seeing here, we know there is an act and there is a section. The next generation, they know only copilot. So thanks again to the initiative of bringing out the new act. In fact, I got an opportunity to be part of the review committee of KSCA, Direct Tax Committee, where the government released the draft before this act, which was passed on August, second week of August. Before that, they released a draft, and chartered accountants all over India were given an opportunity to review the draft. The sections were divided among various chartered accountants, and we were given an opportunity to give the suggestion to the government. So I was a part of the select committee of KSCA. I had an opportunity to be part of that parliamentary select committee meeting which happened in Bangalore, where it was like a parliamentary proceedings, and there were a lot of suggestions, lot of hard work gone from chartered accountants and tax practitioners all over India, and suggestions were given to government, and I was given to understand it was all taken cognizance when she finally passed this act. This being the context, the topics given to me, again thank you, simpler topics, and as far as these three heads of income are concerned, we can be at peace. Like, it is only rearranging sections. There is really not much change in the content and computations. We are yet to get the rules, especially for salary computation on that various allowances, whether there will be any change in the that computation mechanism for various allowances. We are yet to see the rules. They are going to release in January. As far as the basic sections are concerned, there are some rearranging of sections. As you know, the intention of this bringing out the new act was to make it more simpler, reducing the number of sections and avoiding certain expressions like notwithstanding, which was replaced by irrespective, and provisos and explanations, all those which were used to for the past 6 decades, is done away with this new act in the new avatar. And before getting into the sections, what I felt is we as chartered accountants, we may have to now learn to navigate some tables, like certain things, certain deductions and all, they have brought in the form of tables, especially TDS provisions and all. We have to get used to navigate the tables and notes. So that way, that is one of the ways they have adopted to reduce the number of sections. And here I have basically tried to reproduce the text itself. So my slides are little, I mean the whole text I have reproduced because the whole idea is to read the act, right? We have to read the section. And in addition to the PowerPoint slide, I have tried to compare the existing act and the new, I mean the 1961 act and the 2025 act side by side in an Excel spreadsheet. It may not be readable when I present here, but definitely it will be shared. I know Taxman has already come up with the sections, but the text as it is, I didn't find any material on comparison. Maybe it is said to be released, I am not so sure. So I thought that was the way I thought as a student of, I should call myself as a student of income tax, how to learn new thing. First understand from what we already know and see what are the changes. I thought that was the easiest way to appreciate the new act. Very, very simple method. So the first session, I don't know, 3-hour session is there. I'm not so sure if I have so much to discuss for 3 hours. Let us try. So, to set the context, as you know, the computation of total income, section 14 of the existing act. So another challenge is certain sections we have by hearted, right? I mean, as per section, we are so familiar with that section. So now that could be a challenge at least for the next 1 and 2 years, 2 seasons, where the existing section number has been replaced by a new section. So the earlier section will denote a different section. So this, thanks to this taxman, where this first yellow pages, I am sure all of you have seen, is nothing but comparison of the existing section and the new section, both under the existing act and the new act. This is going to be our starting point at least for next 1 year, because we have to really catch up with the new section, reading through the existing sections. So section 14 was the existing section. So left side is the new act, where heads of income, as you know, 5 heads of income we have, that remains the same, no change, where the whole income of a person is computed. And today we are going to discuss the provisions relating to income from salary, house property and other sources. So if you see here, the existing section, we had 3 sections, 15, 16 and 17 as far as salary is concerned, and the whole perquisite valuation under section 17, whatever perquisite valuation, there is a rule, there are set of allowances under section 1014, then exemptions under section 10, income which is not forming part of total income, and read with rule 3, where the various numbers, various limits were set for the calculation of exempt allowances. So there is another chapter. I think you will have a session on income not exempt. So now in the new act, the whole exempt income has been reproduced by way of a schedule. So that is as per the rules it should come. Then a basic definition of salaries and deductions from salaries. So we had only 3 sections in the existing act. Now 2025, they have 15, 16, 17 and 18 profits in your salary separately they have brought in a definition. So earlier act, under section 17 we had the definition of salary perquisite and profits in your salary. Here profits in your salary is a separate section and there is a separate section for deduction. So these are the sections in the new act. First is salary, then definition of salary. What is salary? I mean, what point the salary will be taxed is the first section. Chargeability, basically. Then income from salary, the definition of what does salary include. Then perquisite definition, profits in lieu of salary definition, and deductions. So here it is, the text itself. Here is the chargeability. As we all understand, the provisions remain the same. Salary is taxable on due or receipt basis, whichever is earlier. So if it is on advance salary, if it is received before due in the year of receipt, it is taxable. The provisions remain the same, no change as it is. So the first situation is due from the employer in the year in which it is due or paid, irrespective of whether it is received or not, it is taxed on accrual basis. Then salary, it is not due but received, that is advance salary. Advance salary is also taxed in the year of receipt. And arrears of salary, where it was never due and never received, and at a later point of time it is received. The salary actually belonging to earlier years is taxed in the year of receipt. These basic principles remain the same, and as we know, once it is taxed, it is not taxed again. So no change as it is. one change. So section 15.1 is chargeability. 15.2, this is a new thing. So I'll just show you, as I told, they have mentioned that for the purpose, I'll just read out for the benefit of audience. Section 15.2 specifically says, for the purpose of section 15.1, employer includes former employer, which was not there earlier. Earlier in the text itself, employer or former employer was there. So that is why wherever there is a former employer, they have just used the word employer. This is one change in the new act. So this is what I told, this Excel sheet, what I have done is side by side I have tried a comparison for all the heads of income. This will be shared along with the material. Printability may not be good as such. If any salary paid in advance is included in the total income of any person for any tax year. So here is one change, and I'm sure I think you had 2 sessions on this new act, and we are going to have a very detailed session on 29th, which all of us, I'm sure we are looking forward for that session from Padam sir and Chaitanya sir, where they are going to talk about the basic structure. So as you know, we had in the present act, we had something called previous year and assessment year. Now they have removed that, now we have only tax year. So wherever we read, we have to get used to the expression tax year. So if any salary is paid in advance, is included in the total income of any person for any tax year, it shall not be included again in the total income where the salary actually becomes due. So this is also we are familiar. So from all this reading, what we can understand is whatever judicial precedence principles we have relied upon, including our working paper, that work computation, the tables, all those things we still can use as far as these 3 heads are concerned for the new act also. Now, whether there will be any change in the ideas and all, we have to see what all will happen. Going forward, this also we are familiar as far as, see what is taxed under salary. First basic principle we have learned, any amount received as a part of, as a result of employment is only fall within the definition of. So one of the first fundamental condition for something to be called as salary is there should be an employer-employee relationship. This is all we understand. Based on that principle only, the next section follows. 15.4. Any salary, bonus, commission, remuneration, or whatever name called due to or received by a partner of a firm from the firm shall not be regarded as salary. This we are all familiar because there is no employer-employee relationship between a partner of a firm and a firm. So we have section under the existing and section 40B under business chapter. We have 40 small clause B, where even there in business chapter they are specifically told, irrespective of the name, whatever you call, whether you call consultancy, commission, bonus, salary, even if you call salary also, it is not salary under the Income Tax Act, and there are computation mechanisms. So that is being reiterated as partner's remuneration is no longer a salary within the definition of salary. This also we are aware of this principle. Now comes the definition, no change. It looks very much similar to the existing act. For the purpose of this part, salary includes wages. So as I told you, it is like revision of our understanding of principles of salary, wages, annuity or pension, gratuity, fees or commission. Again, fees or commission as a part of employment. So employment contract is mandatory. Perquisites, then profits in lieu of salary in addition to any salary or wages, then any advance of salary, any payment received by an employee in respect of any period of leave, that's leave salary. So this same definition, no change from the previous act and the new act. Annual accretion to the balance, the credit of the employee participating in a recognized provident fund to the extent to which it is chargeable to tax as per para 6 of part A of schedule 11. So here is the thing. This, as I told you, one of the prominent features of the new act is many things they have brought in as a part of the schedule. So we should be able to navigate the schedules, and we should be familiar with how to take out the information from various schedules. So Schedule 11 of the Income Tax Act talks about the recognized provident fund principles and contributions, how it is taxed as salary in the hands of the employee. So that also is a part of the definition of salary. Again, aggregate of all sums that are comprised in terms. Again, this is recognized provident fund balance. Under part 11.2, part A of Schedule 1 of an employee participating in a recognized provident fund to the extent to which it is chargeable to tax under subpara 4 and 5. So, if you see the Act, there is a schedule, and in that schedule there is a separate table talking about recognized provident fund and what part of the contribution is chargeable to tax as salary. So, that is why it is brought in as a part of the definition of salary here. Then contribution by government or any other employer to any pension scheme. Again, notified pension scheme. As we understand, pension received as a part of employment contract is also a salary. We know there are various computation mechanisms, how we compute the commuted pension taxation, all those things will remain the same. So pension is also a part of the salary. Now this section 124 specifically talks about this 124 of the existing and this Income Tax Act 2025 talks about pension schemes. So any contribution by employer to pension scheme also forms part of the is a salary. Then Agnivir Corpus Fund, this also it is there in the existing Act. Whatever contribution made by the central government to this Agnivir Corpus Fund account of an individual is also a salary. Then section 17, perquisites, remains the same. Perquisite includes rent-free accommodation, then any accommodation given for a concessional rate. If a part of the amount is recovered from the employee, as you know, the differential amount becomes a taxable salary. Then, value of any benefit or amenity granted or provided free of cost or at a concessional rate. Here again specified employee definition they are bringing in, either to a director or to a specified employee, similar to what we have in the existing provisions. Value of any sweat equity, all our ESOPs, RSUs, where the computation mechanism we are familiar with, that is also part of perquisite. That is also remains the same. Allotted or transferred directly or indirectly by the current employer or former employer free of cost or at a concessional rate to the assessee. Value of any other benefit or amenity as may be prescribed. In this clause only, actually the existing Act 17 to clause 8, they have the similar clause, and there is a rule 3 where they discuss various kinds of perquisites like the gift vouchers, then driver facilities, motor car facilities, then gardener allowance, all those things in rules it is mentioned. So we are awaiting the rules, we should see. So here any amenity or benefit as a part of the employment given to the employee, non-monetary consideration, that valuation principles will apply and it will form part of the taxable salary. Any sum paid by the employer in respect of any obligation which but for such payment would have been payable by the assessee. It's a blanket provision, same as the existing Act, given to the employee as a part of salary. Again, employment contract is mandatory here. We have similar thing in business chapter where employment is not the criteria. This is as a part of the employment. Going forward, this all the clauses I have just reproduced. As I told you, it's like reading the text of the Act. Any sum payable by the employer to effect an assurance on the life of the assessee, or to effect a contract for an annuity either directly or through a fund, other than the specific funds, because this is already covered. Recognized provident fund, approved superannuation fund, we have separate clauses. So that's why it is excluded from here. Any contribution in excess of 7,50,000 in a tax year made to the account of the assessee by the employer. We have similar provision now also. It is taxed as perquisite to these funds. Recognized provident fund. Section 124 talks about other funds other than recognized provident funds and approved superannuation fund. Taxed as perquisite. Annual accretion by way of interest, dividend or any other amount of similar nature during the tax year to the balance at the credit of the fund or scheme referred to in clause H computed in such manner as may be prescribed to the extent it relates to the contribution referred to in said clause in any tax year. So here it is going back to the, it is referring to clause H. Again, all the contributions by the employer as a part of the salaries, basically they want to tax as perquisite here. Then there are exclusions. certain benefits even if given to the employee as a part of the employment, it is not considered as a taxable perquisite. Nothing in subsection 1 shall apply to value of any medical treatment provided to an employee or member of his family in any hospital maintained by the employer, similar to the existing provision. Any sum paid by the employer in respect of any expenditure actually incurred by the employee on his medical treatment or treatment of any member of his family. In any hospital maintained by the government or local authority or any other hospital approved by the government for the purpose of medical treatment of its employees. So practically, if you are a person who is filing a tax return, all this may not be relevant. It comes as a part of, as I told you, Form 16. But if you are in advisory role where you are in payroll structuring and all, only all this really matters. In respect of the prescribed disease or ailments in any hospital approved by the Principal Chief Commissioner or Chief Commissioner having regard to such guidelines as may be issued in this behalf. Yet to come, that guidelines. Any portion of the premium paid by an employer in relation to an employee to effect or to keep in force an insurance on the health of such employee under any scheme approved for the purpose of section 30C by the central government or IRDA. Medical insurance is not a taxable perquisite. Same benefit given to the member of the family under any scheme approved by the central government or IRDA. Any expenditure incurred by the employer for the use of any vehicle for the journey by the assessee from his residence to his office or other place of work or from such office or place of his residence. So these are exclusions from the definition of perquisite. Any expenditure incurred by the employer or any sum paid by the employer in respect of any expenditure actually incurred by the employee on. So in the definition we saw if any obligation of the employee is met by the employer, it is a taxable perquisite. In this exclusion, in these particular situations, it is not considered as a taxable perquisite. Medical treatment of the employee or any family member of such employee outside India, travel and stay abroad for the employee or any member of the family of such employee for medical treatment, travel and stay abroad of one attendant who accompanies the patient in connection with such treatment. Similar provisions are there in the existing Act also. Yeah.
Can you give the example for any expenditure incurred by the employer or any sum paid by employer in respect to expenditure actually incurred by the employee?
On medical, so here this is exclusion, sir.
Yeah, exclusion. So my point is the first one. The first example.
So it is actually subclause of that clause F.
Okay.
Clause F, any expenditure incurred by the employee for medical treatment. Otherwise, other than that, any obligation of the employee, for example, child school fees. Simple example I am saying. School fees, actually the obligation of the employee to pay the fees of the child. If the employer is paying, it is a taxable as a part of his salary. Even per diem allowance, unspent per diem allowance is taxed like that only. They will travel and per diem allowance unspent without submission of the bills will be taxed as a part of taxable salary. So these subclauses are exclusions. So here again clarification. For the purpose of subclause subsection 2F, which we discussed above, the expenditure on medical treatment and stay abroad shall be excluded from the perquisite only to the extent permitted by RBI. So there will be guidelines. So only up to that limit it will be excluded. Like the way we have similar in leave travel, LTA allowance calculation, where they say if the connectivity is by rail, only that to that extent exemption is allowed. Even if somebody travels by aircraft, that will not be allowed. So like that, it's based on RBI guidelines, they will fix the limit for the exclusion. To that extent, it will not be taxed as perquisite. The expenditure on travel shall be excluded from perquisite only in the case of an employee whose gross total income as compared before including therein such expenditure does not exceed such amount as may be prescribed. Now we have to wait for the limit. What is the limit? So as we saw earlier, specified employee and director. So the limit is prescribed. Within the prescribed limit only the exemptions will be allowed. Beyond that limit it will be taxed. So all this, as I told you, relevant for salary structuring. Now definitions are there. For the purpose of this section, what does fair market value mean? What is family? What is gross total income? What does hospital includes what? So on and so forth. So again they are drawing attention to the schedules. option for ESOPs? What is an option? What is a specified security? Definition of equity shares, no change. Value of any specified security or equity shares shall be fair market value of the specified security. So as you know, we know the present value calculation, right? Fair market value minus the excise price. That becomes a taxable purchase. Makes the same. Reduced by the amount actually paid or recovered by the assessee, recovered from the assessee in respect of such security or shares. So basically the definition. Next, so there is perquisite, section 17. Next, section 18, profits in lieu of salary. What does it include? The amount of any compensation due to or received by an assessee from his employer or former employer at or in connection with situations where somebody is given a compensation as a part of termination of employment or modification in the terms and conditions of employment, then it is taxed as profits in lieu of salary. So actually there is no underlying employment contract. That's why perhaps the word profits is used. Because anything to be salary, there should be an underlying employment contract. But this is given in a unique situation where the employment contract is terminated and it is a compensation given in lieu of that. So profits in lieu of salary, taxed as salary. Any amount due to or received, whether in lump sum or otherwise, by any assessee from any person before joining employment or after cessation of the employment. That's why this is not a new thing. This is there in the existing act also. Since we are revisiting the provisions, I thought, why profits in lieu of salary? In lieu of salary, because it is also incidental, or the underlying event is an employment. But at the time of giving this money, the employee is not in the role. Any payment due to or received by an assessee from an employer or former employee. So in all these places, if you see, unlike in section 15, first when we saw, they didn't use the word former employer in any of the clauses, and they had a separate clause 15.2 saying that employer includes former employer. But in section 17, perquisite definition and also profits in lieu of salary, they mentioned employer includes former, employer or former employer like the existing act. So I did not understand what they achieved by that, because in 15.2 they told employer includes former employer, but in 17 they continued to use employer or former employer. Don't know whether it was a miss or don't know. So here also from an employer or a former employer, then from a provident fund or other fund to the extent to which it does not consist of contributions by the assessee or interest on such contributions. So these are unique situations where it is taxed as salary. Any sum received under key man insurance policy as defined in Schedule 2 Note 1. Actually, if you see the text, it is Note 1. I will show you that Income Tax Act where schedules are there. So in Schedule T, in Schedule 2 there are many definitions. There is a Schedule 2. I will show you the schedule. There is a schedule as a part of the Income Tax Act. In that, many things are there, and then down the schedule there will be note, and in that note, clause C, note 1, note 2, note 3, many notes are there. In note 1, clause C defines what is a key man insurance. Because the key man insurance will be, wherever key man insurance is mentioned, they will draw attention to this particular note. That's why I told you that navigating schedule you may have to be familiar. And you see, next again, lot of they are referring to schedules. The payment referred to in subsection 1C shall not include any payment referred to in schedule 2 table. So schedule has many tables. Table serial number 3, 4, 5, 3, 4, 8, 11. So these items, if you have to know, I don't know if I can show you the PDF act. Just to get familiar. Take some of this out later. Have the act here. to show it before the session concludes. I'll take somebody's help and show you. The act, how the schedule comes. It's very important to be very familiar how to, excuse me, So these are not a part of the profits in lieu of salary. Now comes deductions. So last section, deductions from salary. Standard deduction remains the same. New regime, all remains the same, 75,000, 50,000. Then tax on employment, gratuity, community pension, retirement compensation, voluntary retirement compensation, leave encashment. So same, this type of deductions also is given by way of a table. I'll show you the table, let me take it, that help. Where they have told what deduction is available and how much of the gratuity is available as deduction, how much of the community pension is available as deduction is given by way of a table as a part of the Act. This is one comparison of the exclusions. See, under section 10 we have certain category of salary payments by which we compute the exemption for gratuity, pension and all, we compute the exemption, right? So the section under the existing Act and the new Act is under deduction, section 19. So this is a comparison of the existing Act and income tax, 2025 Act. So here if you see gratuity, they have drawn reference to section 19. As a part of section 19 there is a table, I will show you that. Then as far as non-monetary perquisites, 10C, if you see, they are drawing attention to schedule 3. So we should know how to see schedule 3, clause 10. There they have mentioned how to compute that exemption. So here schedule 2 again. So schedule 2, schedule 3, then section 19. These are the 3 things which we have to remember to understand the deductions from salary income. That's all I have for salaries. Wish somebody helps me to show that income tax act. Any questions?
Out of the profits in lieu of salary, if a person leaves before the due date or before the timeline and he has to pay back some amount in lieu of that, will that be taken as a deduction?
No. So what I have seen, I had a similar situation. Net settlement they will give. So what hits his bank account is considered as a salary. That's how they did in that Form 16.
But
like you can't
Form
claim a
16,
deduction.
they are taking it as a gross income, like whatever was due. But they took back in the next financial year, they took back the money. But how to treat that?
No. To the best of my knowledge, he can't get any deduction other than that specifically discussed in the Act. Yeah. If anyone has any experience in payroll structuring, one situation I had was similar thing. So it came back and we gave an advice. Actually, it was a very practical advice. I told whatever comes in Form 16 gets taxed. So better go back to the payroll team and make sure that in the Form 16 only what net amount is shown as a taxable salary.
What I had done
Yeah, but the
is, because as
financial-
per 26 years, we have to show the gross amount.
Yeah.
I had shown it as a gross amount and taken as a deduction
Deduction.
what paid back, because actually that money was
But
not
if it
received.
comes in Form 16, very unlikely. But deduction under which section? Because there are specific sections for
Others,
it.
I mentioned as others and wrote like a line saying that this was returned back as.
Should try, ma'am, because
That's what I did, because that
Assessment.
is actually not received by the employee, so I.
I was
And Carpenter, authority to the company. What is the penalty?
They don't know.
Give the company advance. They take back some more bond amount from employee. This is the penalty of a penal nature.
That's what I.
Yeah.
Penal nature means they are not part of
They will
company.
not allow as a deduction.
So the other is more the company.
Yeah.
37 is the time. You have no.
Salary assessment, so far I have not, see, Only one case I had where really the employee was not in a position to submit that medical bills because she was on maternity, so she couldn't submit to that corporate employer. We, in the erstwhile thing, we claimed through bills.
Right.
It was an adventure I did, but they called and luckily they allowed.
Yeah.
That is the only personal experience I had, to be very honest with you. That's what opening statement I made. Salary as well as my experience is concerned, it ends only with Form 16 because we see at the time of filing individual returns. That's why it was an opportunity to revisit how salary structuring is happening. But this is a very relevant point. Practically, I had the situation, we had a Form 16 and this guy, in fact, there was a spillover. Next financial year only it happened.
Right.
In fact, it didn't happen from, in my case, it didn't happen from his personal account also. It was given by the other employer. Because it was like he was a very high, what is called, talent. So the other employer was made to pay that money. Yeah, so it was a complicated thing, but I told whatever it is, get it in the Form 16.
Yeah, because as per 26 years, what is
Yeah.
showing as gross, we need to take it in the filing.
Yeah.
Because if we don't do that,
Yes.
they'll apply Rule 37A and disallow that.
Yeah, we'll get a notice from CPC.
Yes.
Who doesn't
So I
understand
thought
it.
I'll take a gross and then take the expense.
We luckily got it rectified in the Form 16. The second employer, we spoke to the second employer and first employer is out because they would have outsourced it to some people, nobody
Right.
will be available. And they reworked on that gross salary part and they got it done because he was a very sought after
Right.
person. Yeah, he had that hand. It was actually I didn't know and the amount was quite big, so it had a serious impact on his taxes. But to my mind, there was no specific section which he
No,
put
there's
in
no
the
specific section of
Yeah. We work on the gross salary only.
Yes.
So this is the, so 498 is the page number of the schedule. So this is how schedule 2 comes in the act. Is it visible? Little more. Just to be familiar, along with you I am also getting familiar with the new act. So income, so this schedule 2 actually talks about our chapter 3, income not forming part of our exempt income. Okay. In this, as we know in the existing act also, some 10 subsection 10 CC like that, some of the sections of 10 is relevant for salary income, for gratuity, pension and all. So schedule 2, in this, the whole exempt income is in schedule 2 now. This is how the number of sections were reduced in the new act. Right? So in this, you have to see which schedule number. So in the PowerPoint, we refer to some schedule 2, right? If you see here, schedule 2 table, in the table serial number 3. So if you go here, this is the table and in this serial number 3, we should refer. That is how you have to understand to read this schedule. Serial number 2 is insurance policy. So this is similar to, I think, our 1010B. And serial number 3, we should find something in the nature of salary. Any payment from Provident Fund to which the PF Act applies or from any other Provident Fund set up by the central government, the income by way of interest accrued during the tax year shall not be eligible for exclusion from the total income where it is attributable to the contribution that limits 5 lakhs and 2,50,000. So this is how we have to compute the taxable component of the salary. You have to read the schedule. Then another, so this is how the schedules come. And another thing I wanted to show you how the deduction table is coming. Section 90, deductions from salaries. This is how it is coming. Income chargeable under salaries shall be computed with the following. So, sum paid by the SSC as a tax on employment as per Article 276(2) is tax on professional tax actually. Constitution clause 2 talks about professional tax at 2,500 whatever we pay. First time in my life I read Constitution of India article, this relevant article, I don't know idea. I have to depend on him to show it means. Yeah, see. Article 276 clause 2. Total amount payable in respect of one person to the state or to any municipality, district board, local or local authority in the state by way of taxes on professions, trades, callings and employments shall not exceed 2,500 per annum. So it is coming from Constitution. This is the tax which they are talking about in this table. Article 276(2) of the Constitution of India, PT basically. Then standard deduction, death cum retirement gratuity, entire amount. So now here referred to in subsection 2G. Now we have to go to subsection 2G of section 19 of what category of gratuity it is discussing. Then payment of retiring, this is central government gratuity actually. Payment of retiring gratuity under pension code. So various categories of gratuity, then under POGA, payment of gratuity act, that the relevant section of the said act they are discussing. So here is the deduction from salary. This table we need to remember for various deductions from salary, section 90 of the new act. Now we need to wait for the rules. Rule 3. Similar to the Rule 3, the rules are expected in January. We should see how the various perquisites are being valued. That's all I have for salaries. Now we should see whether any change in the form 16, whether any changes will happen. So wait and see. And TDS provisions, to the best of my knowledge, is only in the table. I don't think there is any change. I have not read in detail, but my basic understanding, there is no change in the deduction of TDS from salary. It is similar to section 194. Now, income from house property. Actually, that profits in your salary, one practical thing which I came across, may not be so relevant from this act point of view, because we discussed when you have somebody earning salary, somebody has become resident in India and they have a salary portion from their employment outside India, they have some similar concept like profits in your salary, which is not a salary in their act. So if we are claiming any double taxation credit, we will have a problem, because it is a salary in the Indian context, but it is not a salary, so we will not find the tax calculation at par with when we compute the average, to claim the tax credit, it is a problem. That is one practical thing which I came across in the context of profits in lieu of salary. But that problem remains even with the new act. Very rare situation. Now income from house property, peaceful, no change. Everything remains the same. Whatever we have learned. So all the challenges also remains the same. The deductions, everything remains the same, no change. Only, as I told you, some rearrangement of sections. So here is the comparison. Existing Act 22 to 27 were the provisions of income tax, income from house property. Now it starts from section 20. Section 20 is income from house property. 21, determination of annual value. 22, deductions from income from house property. 23, arrears of rent, unrealized rent received subsequently. Principles remain the same. Section 26, we had co-owner property. Now it is section 24. And 25 is interpretation. So interpretation basically you will find in many sections. It's basically the definition. For the purpose of, we used to read now, for the purpose of this section, we used to read in the existing act. So interpretation, they will define. In this case, they have defined who is an owner, all those things. That's all. So we had section 27. If you see earlier in the existing act, we had section 27 where they have defined who is an owner and what is annual charge. Now, in the existing act, they brought in everything under section 25 as interpretation. That's all.
This 25 and 25A is not there, huh?
No, 25.
You have removed it.
25 and 25A, unrealized rent, and that is now as section 23, sir. Arrears of rent and unrealized rent. Principles remain the same. So really, the challenge is that certain sections are by heart now that we have to unlearn. Chargeability, the annual value of the property consisting of same. Any buildings or land appurtenant thereto owned by the assessee shall be chargeable to income tax under the head income from house property. Remains the same. And provisions of subsection 1 shall not apply to such portions of the property as occupied by the assessee for his business or profession, the profits of which are chargeable to income tax. Even now we have that. If he is using it for the purpose of his business or profession, then and his that income will not be taxed under income from house property. Here we have the existing act only. We have some challenges of service apartment and all that we are not getting into because the purpose of this section, session is to understand the new income tax act. So this thing remains the same. In the existing act also it was. See here, just I don't know. I'll read out. So here is the new one. Existing act. The sentence was. The annual value of the property, I'll read out, I know it is difficult to read. The annual value of the property consisting of any buildings or lands appurtenant thereto of which the assessee is the owner, other than such portions of such property as he may occupy for the purpose of any business or profession carried on by him, the profits of which are chargeable to income tax, shall be chargeable to income tax under the head income from house property. This was the existing clause. So this only they told it is difficult to read. That they made it simpler by how they did, by saying, by introducing two subclauses for the section. 20 subsection 1 they told, simple, the annual value of the property consisting of any buildings or lands appurtenant thereto owned by the assessee shall be chargeable to income tax under the head income from house property. First sentence. Next. This subsection 1, that whatever principles of computing the income from house property shall not apply if a portion of the property is let out, he is using for the purpose of his business. Then whatever, and the profits are chargeable means these principles under which we compute the income from house property is not applicable. So the existing thing only they reproduced by way of two sections. This is how they made simplification. Now the challenges here remains that we will not discuss now. Definitely. How it can be, if he is taking a rental income from his own business income, whether it will be a rental income, all those challenges remain. Whatever challenges we had so far remains. That's the point. Now section 21.1. Next. For the purpose of section 20, now definition of determination of annual value. The annual value of any property shall be that fair rent. So here that principal rent, fair rent, all those things they are not saying. Simple. For the purpose of section 20, the annual value of any property shall be deemed to be the higher of the following. The sum for which it might reasonably be expected to let out from year to year, that is the fair rent. Actual rent received or receivable by the owner if the property or any party is let out. So actual rent received or receivable or fair rent, whichever is higher will be the taxable rent. Same thing. If you see the existing act also, this is the existing determination of annual value. See, this was the existing thing. I am reading the existing thing. You can listen. Annual value, how determined? That was the existing thing, section 23. I am reading out. For the purpose of section 22, the annual value of any property shall be deemed to be 1. The sum for which the property might reasonably be expected to let from year to year. That remains the same sentence they have introduced. Next. Where the property or any part of the property is let and the actual rent received or receivable by the owner in respect thereof is in excess of the sum referred to in clause A, the amount so received or receivable. So again comparison with the fair rent and actual rent, whichever is higher. So that also remains the same. These are the only two things in the new act. Now what further we had here? We had clause C. What was it? It was about vacancy situation. So clause C talks about vacancy, which they introduced by way of next section. So clause C talks about existing act 1961, where the property or any part of the property is let and was vacant during the whole or any part of the previous year, and owing to such vacancy of the actual rent received or receivable by the owner in respect thereof is less than the sum referred to in clause A, means less than the fair rent, the amount so received or receivable. So basically vacancy allowance was allowed in the existing provisions. Now the same clause C is reproduced as 21.2. What they told, if the property or any part of it is let and was vacant for the whole or any part of the tax year, again tax year, there it was, I think the word whole or any part of the previous year. So there is no concept of previous year, it is tax year now. So that they changed diligently. and owing to such vacancy, the actual rent received or receivable by the owner in respect thereof is less than the sum referred to in clause 1A. What is 1A? Fair rent. The annual value of such property shall be deemed to be the amounts of receivable. It's the same thing. Only the new avatar by way of clause 21(2). Next. Going forward. In the same section 23 itself, our existing act spoke. What did it speak? Provided. So here 21(1), 21(2). Next 21(3). In the existing thing, it was a part of the section 23 itself. What they told? Provided. So this provided is not there in the new act. Explanation is not there as of now. I don't know in future what will happen. As of now it is not there. So that all they made as subsections. Provided that the taxes levied by any local authority in respect of the property shall be deducted irrespective of the previous year in which the liability to pay such taxes was incurred by the owner. We know this. It has to be actually paid. It is not in the year in which it is accrued. We ask for the tax paid receipt. Even if it belongs to the earlier years, they can claim in the year of payment. Even if it is advance payment, they can claim in the year of payment. This already we know. According to the method of accounting regularly employed by him in determining the annual value of the property of the previous year in which such taxes are actually paid by him. On payment basis, it is allowed. Then further, in the existing act, explanation was there. For the purpose of clause B or clause C of the subsection, the amount of actual rent received or receivable by the owner shall not include, subject to such rules as may be made in this behalf, the amount of rent which he cannot realize. What is that? Unrealized rent. So, rent received or receivable, from there vacancy allowance we remove, from there unrealized rent we remove, and from there we remove property taxes and we arrive at the annual value. Same thing here, achieved by way of many sections. How a country will grow, one paper made in 4 paper and our GDP will go up. Like that, one thing he made in 4 sections. Unrealized rent. So he told the same thing. First day he spoke about property tax. Same sentence. Local authority actually paid irrespective of the year in which it became payable. Irrespective of when such taxes became payable, it is allowed on payment basis. 21(4) Unrealized rent. The rent which cannot be realized by the owner shall not be included in computing the actual rent received or receivable, subject to the rules as may be made in this behalf. Then, so whatever we read in section 23 is over here. Okay, next, existing. 23(2) we had the annual value. Actually here I will go in the present in this order. That will be easier. 21(4) unrealized rent over. Now next, 21(5) stock in trade properties. This we know. We have the existing provision where if a builder has stock in trade of the, or somebody who has stock in, basically builders only, they will have current asset of the unsold flat up to 2 years, no problem. After that, rental income has to be reported, deemed rental income. Same thing. Where a property is held as a stock in trade and is not let wholly or partly at any time during the tax year, the annual value of such property or part thereof shall be nil for the 2 years from the end of the financial year in which the certificate for completion of construction is obtained from the competent authority. This is the new act. Now we will see what was there in the existing act. Existing act, it was in a different section. Here, it was in 23(5). Okay, I will read out 23(5). So 21(5) is here, where it was 23(5). Where the property, same sentence, where the property consisting of any building or land appurtenant thereto is held as stock in trade and the property or any part of the property is not let during the whole or any part of the previous year, the annual value of such property or part of the property for the period up to 2 years from the end of the financial year in which the certificate of completion of construction of the property was there, here of the property is not there, is obtained from the competent authority shall be taken to be nil. That was the sentence there. Here they have told, first they told in nil. It's a rearrangement of some words. Right? So, peaceful, no problem. Principle remains the same. Next, 21(6) self-occupied properties. What is the rule? The annual value of the property consisting of a house or any part thereof shall be taken as nil if the owner occupies it for his own residence or cannot actually occupy it due to any reason. So this 21(6) here also the annual value 23(2) it is The annual value of the property consisting of a house or any part thereof shall be taken as nil if the owner occupies it for his own residence or cannot actually occupy it due to any reason. Here one point, see we used to struggle now. For the purpose of his employment or profession, he cannot occupy the property. In the Bangalore itself, he is working in Whitefield, he has a property in Jayanagar. Now that amendment they brought in Finance Act 2025 only. Not in Income Tax Act 2025. Finance Act 2025, those provisions are removed. If you see the act down, they have substituted. I think I have the act here. Because I got that out when I read it. Because we used to suffer to prove no why this man, whether we can claim HRA. So I have the act here. For the benefit of the audience, I'll read. Maybe people are familiar. I thought it is a good idea because this Finance Act 2025 very limited use only, but for 1 year we have to read it. Here under 23, they down if you see they have substituted that 23. So earlier, if you see here, the 23.2, I am reading from the Finance Act, Income Tax Act, Finance Act 2025. The annual value of the property consisting of a house or any part thereof shall be taken as nil if the owner occupies it for his own residence or cannot actually occupy it due to any reason. That they have amended. Earlier, prior to the amendment, with effect from 1/4/25, earlier it was, prior to its substitution, subsection 2 read as under. I am sure we are all familiar with this. Where the property consists of a house or a part of a house which is in occupation of the owner for the purpose of his own residence, no problem, or cannot actually be occupied by the owner by reason of the fact that owing to his employment, business or profession carried on at any other place, he has to reside at that other place in a building or not belonging to him. The annual value of such house or part of the house shall be taken to be nil. This was a benefit given. So we used to have this. In the same city, he will take a house on rent and he will claim HRA. This house he cannot because various reasons. So that thing they substituted in Finance Act 2025 only. So don't think that this is a new thing in this new act. Finance Act 2025, they told that due to any reason. They have removed that word business or profession, all those things they have removed. This is something which I thought we should discuss. So compared to Finance Act 2025 and Income Tax Act 2025, no change. As far as self-occupied property is concerned, the annual value is nil. So 23.2 is in our thing 21.6. This 21.6 we should remember because he will draw attention to this 21.6 in many places. In the interest on borrowed capital, then in co-ownership, many places he will refer to 21.6. So keep in mind 21.6. Okay. Next. Section 21.7. Limit on self-occupied property benefit. Okay, so this also we have in the, so what is the section talking? The provisions of subsection 6, that means 21.6, shall apply only in respect of 2 houses, which we know. First earlier we had only 1 house, then they amended 2 houses as specified by the assessee. So the assessee has a choice out of how many, I mean from 4 or 5 houses, 2 houses he can choose as self-occupied property. And it shall not apply if the house or any part thereof is actually let during at any time during the year or if the owner derives any benefit therefrom. The rule remains the same. If any benefit comes, he will not be given the benefit of declaring nil annual value. Same thing in the existing thing we had. Here 23.3 it was. 23.3 section 23.3 same thing. The provisions of subsection 2. That means what is subsection 2? Declaring annual value nil shall not apply if the house or part of the house is actually let during the whole or any part of the previous year. There it was previous year. Here they told the tax year I think. Any part of the letter during any time of the tax year. So previous year is not there, and any other benefit is derived there. So same thing, 23.3. Now it is 21.7. That's all. Next, reduction from income from house property. So earlier income, I mean our 1961 Act section 22 was the charging section for income from house property. Now charging section is section 20 and deduction from income from house property is section 22 in the new Act. The income under the head income from house property shall be computed after making the following deductions. What are the deductions? We know 30% standard deduction in respect to the actual expenditure remains the same. Then interest on borrowed capital, all the principles remain the same. When the property has been acquired, constructed, repaired, renewed or reconstructed with borrowed capital, the amount of any interest payable on such capital is allowed as a deduction. 222(1)(c) pre-construction period interest remains the same principle. where the capital referred to in clause B is borrowed during any period prior to the tax year in which the property has been acquired or constructed, the amount of any interest payable for such prior period in 5 equal installments for the said tax year and for each of the 4 immediately succeeding tax years. Rules remain the same. Then here we had in section 24 all this, right? Reduction from income from house property. We had all this by way of provisos and explanations. For our understanding, I'll just read out the existing deduction, how it comes. Income chargeable, this is the existing act I am reading. Income chargeable under the head income from house property shall be computed after making the following deductions, namely a sum equal to 30% of the annual value. Where the property has been acquired, constructed, repaired, renewed, reconstructed with the borrowed capital, the amount of any interest payable on such capital. Then we had provisions, provisos, provided that in respect to the property referred to in subsection 2 of section 23.2, which is self-occupied property. 21.6, 23.2 in our existing act was a self-occupied property. The amount of deduction, or as the case may be, the aggregate of the amount of deduction shall not exceed 30,000 rupees, where that it is not for repair, there are some conditions, it was restricted to 30,000. Then, provided further that, where the property referred to in the first proviso is acquired or constructed with capital borrowed on or after 1st day of April 1999, and such acquisition or construction is completed within 5 years from the end of the financial year in which the capital was borrowed, the amount of deduction, as the case may be, the aggregate of the amounts under this shall not exceed 2 lakh rupees. These were the conditions. Then we had explanation. Where the property has been acquired or constructed with borrowed capital, the interest, if any, payable on such capital borrowed for the purpose prior, this is pre-construction period interest, prior to the previous year in which the period has been acquired or constructed, as reduced by any part thereof, allowed as a reduction under any other provision of the act, shall be deducted under this clause in equal installments for the said previous year and for each of the immediately succeeding previous years. Then one more, proviso also that no deduction shall be made under the second proviso unless the assessee furnishes a certificate. All this he will bring in by way of subsections. That's why I am reading this. You listen, certificate requirement. Next, from the person to whom any interest is payable on capital borrowed, specifying the amount of interest payable by the person for the purpose of such acquisition or construction of the property or conversion of all or any part of the capital borrowed which remains to be repaid as a new loan. So, the need for a certificate. Here only any interest payable on capital borrowed from any person. That's why we know it is not necessary that they should take the loan from a bank or a financial institution to claim the interest on borrowed capital as a reduction. Even personal loan with a certificate saying that this is the interest, we can claim as a reduction under 24, not under that 80, chapter 6 reduction we won't get. Anyway, coming back, the need for a certificate was mentioned by way of a proviso in the existing act. Next, explanation. For the purposes of this proviso, the expression new loan means the whole or any part of the loan taken by the assessee subsequent to the capital borrowed for the purpose of repayment of such capital. Then, provided also that the aggregate of the amount of deduction under the first and second proviso shall not exceed 2 lakh. This was the existing section. Now, how in the new thing all this is achieved, we will see. Standard deduction 22.1a, 22.1b interest on borrowed capital we read, 22.1c reconstruction period interest. Next, limit, that 2 lakh limit he is bringing by way of a section 22.2. Limit for self-occupied properties. In case of property or properties referred to in 21.6. 21.6 is self-occupied property, similar to 23.2. The aggregate amount of deduction under subsection 1b shall not exceed 2 lakh, subject to the following conditions. The property has been acquired or constructed with borrowed capital and such acquisition construction is completed within 5 years, means 2 lakh will get. Otherwise, 30,000, and assessee furnishes certificate from the person to whom the interest is payable. So it is a separate section. All the things what we read is by way of proviso and explanation, it is by way of a section here. Then 22.3, reducing pre-construction period interest, which is also there in our existing thing. Whatever already claimed as a reduction, we can't claim again. That is also there in one of the sections. I think up to somewhere it is there. 23, 24. Already claimed as a reduction, we can't claim it again. In pre-construction period interest, we will discuss that. I'll come back here. The reduction under section 22.1c shall be computed after reducing the interest referred to in such section by any amount already allowed as a reduction under any other provision. So here he says if you have already claimed that interest as under any other provision of this act, then you can't claim it again. Basic principle, no double deduction. Then see, 22.4, he told interest certificate. The certificate referred to in subsection 2 shall specify what all it should include: the amount of interest payable on capital borrowed and the interest payable on any new loan where subsequent to the capital borrowed, thus he has taken any such loan for repayment of the borrowing part of such capital. Then, aggregate cap. It is by way of a section now. Section 22.5, the aggregate of the amounts of deduction under subsection 2 in respect of properties of the nature referred to in 21.6. 21.6 again, self-occupied property shall not exceed 2 lakhs. That limit is not there for letter of property. We are talking about deduction, not carrying out of losses. Don't get confused. Then 22.6, disallowance of interest payable outside India. This is also there in the existing provision. You have to make sure TDS is done. Any interest chargeable under this act is payable outside India shall not be allowed as a deduction under section if the tax has not been paid or deducted on such interest under chapter. Now it is what is this 19B. And so this is a new chapter for TDS. And in respect of such interest, there is no agent in India as per section 306. So agent 163 and all, now 306. Okay. So that's all. That's all about deduction. So did anyone find anything new? I couldn't find anything new. It is all the same. Sections are different.
So there's also a new scheme, old scheme in the...
Yeah, it is there, sir. That's there. New scheme, old scheme is there. So that's in salary they told me, salary deduction, 70,000 for new scheme, old scheme. That's there. That's it. That's a favorite topic of very much is there. Ideas of rent and unrealized rent received subsequently. Principle remain the same. So what is arrear of rent and what is unrealized rent? Arrears of rent is it was never due. Arrears we understand best in the context of DA arrears of central government employees, because it was never due. Government never announced DA, and at some point they told that for so many number of years we will give you DA. So it was never due, and so obviously not collected. Unrealized rent, it was due but not collected. This is the difference, arrears and unrealized rent. So taxability of arrears, obviously in which year you will tax? You will tax in the year in which it is received. Amount of arrears of rent received by an assessee from a tenant or unrealized rent realized subsequently from a tenant shall be deemed to be the income of the house property in respect of which the tax year in which such is received away. So unrealized rent and arrears of rent will be taxed in the year in which it is received, irrespective of the ownership. This principle also was very much there in the existing act. Even in the year in which the property is already sold also, if he receives the money, it is taxable as income from house property. He may not be the owner, he may not have a property, but still you have to tax it as. So all this will come out when you have a credit in, if you go through the bank statement, there could be some. Practically, I have never come across a situation. And unless there is a TDS, the next question whether TDS to be done, all those questions, so on and so forth will follow. Anyway, coming back to our topic, irrespective of the person is owner or not, it is taxable. Very much similar to the existing provision. Then a sum equal to 30% is even allowed as a reduction under arrears of rent and also unrealized rent. Then co-owners. Same principle. So here it was similar to section 26. You see for our, I'm not sure, at least I had not seen that section for a long time. This was an opportunity to see that section. So here the existing thing 25A, you asked no sir. So amount not deductible from income from house property, notwithstanding anything contained in section 24, any interest chargeable under the act which is payable outside India on which tax has not been deducted under chapter 17B, our existing act, in respect of which no person in India may be treated as agent under section 163 shall not be deducted. 25, which is similar to that one. 25A, special provision for arrears of rent and unrealized rent subsequently. So that is now a new section. 26, let us see what is there in the existing act. Where property consists, the existing act I am reading, 1961. Where property consisting of buildings or lands appurtenant thereto is owned by 2 or more persons and their respective shares are definite and ascertainable, and such person shall not be in respect of such property be assessed as an AOP. So they told that multiple owners, if their shares are definite and ascertainable, it will not be taxed as AOP. The respective income will be taxed in the hands of the respective owners. AOP, but the share of each such person in the income from the property as computed in accordance with section 20-25 shall be included in the total income. Existing provision. Then explanation. For the purpose of this section, in applying the provisions of the subsection 2 of section 23 to that self-occupied property, for computing the share of each such person as referred to in this section, the share shall be computed as if each such person is individually entitled to the relief provided in that subsection. So each person's computation annual value will be there. That's what they gave by way of an explanation. All these were the outcomes of various judicial precedents. So you know that I mean they used to bring it as explanation or clarification for the removal of doubts. All those we used to see. Now, present act they have told nothing will come. We have to wait and see. Then owner was defined under section 27. Owner, annual charge, etc. defined. For the purpose of section 23 to 26, existing act, an individual who transfers otherwise than for adequate consideration any house property to his or her spouse, not being a transfer in connection with an agreement to live apart, or to a minor child, not being a married daughter, shall be deemed to be the owner of the house property so transferred. So, irrespective of the transfer, if these are the situations under which transfer happens, the original person becomes the owner. He shall be again deemed to be the owner and income will be taxed in his hands. Next step. The holder, so these were the owners that for the purpose of section 26 who is an owner, or for the purpose of this chapter, I mean the income from house property chapter itself, owner is defined here. Next step. The holder of an impartible estate shall be deemed to be the owner of the individual owner of the properties comprised in the estate. A member of a cooperative society, company or other association of persons to whom a building or part thereof is allotted or leased under a house building scheme of the society, company or association as the case may be, shall deem to be the owner of the building or part thereof. That house building societies where ownership comes through by way of that document. Then 2A, a person who is allowed to take or retain a possession. So ownership, the actual transfer may not have happened, but under Transfer of Property Act he gets the possession. That is, they are deemed to be an owner. The person is deemed to be an owner. Retain possession of any building or part thereof in part performance of a contract of the nature referred to in section 53 of the Transfer of Property Act shall be deemed to be the owner of that building or part thereof. A person who acquires any rights, including any rights by way of lease from month to month or for a period not exceeding 1 year, in or with respect to any building or part thereof by virtue of any such transaction as is referred to in clause F of section 269 UA, shall be deemed to be the owner of that property, building or part thereof. Then last, the taxes levied by a local authority in respect of any property shall be deemed to include service taxes levied by the local authority in respect of the property. These are all the definitions in the existing act. Same thing, property, same thing. The property owned with a definite and ascertainable share, the principle remains the same. The owners shall not be assessed as AOP. Their income computed separately under this part as per their respective share shall be included in their total income. No change. Relief. The relief available under section 21(6), I told you, 21(6) self-occupied property, similar to 23(2) of the existing act, shall be provided as if each owner is individually entitled to said relief. Each owner can claim self, so this I wrote actually, this is not in the section. Each owner can claim self-occupied status for their share and they can claim deductions under section 22, interest and all, so on and so forth. For the purpose of now interpretation, same to definition. For the purpose of section 20 to 24, the owner in relation to a property or in part thereof shall include an individual who transfers without adequate consideration any property to a spouse except under an agreement to live apart or to a minor child other than a married daughter. Holder of an impartible estate, he shall be deemed to be an individual owner in respect to the properties comprised in the estate. A member of a cooperative society, company or association to whom a building or part thereof is referred to is under a house building scheme of the society, company or association. A person who is allowed to take or retain possession of any building or part thereof in part performance of the contract with the nature of in 53 of the Transfer of Property Act 1882. That's it. Then next step. Any person who acquires any right, lease, that lease rights from month to month over a period not exceeding 1 year in respect of property or part by virtue of transfer of such property by sale, exchange or original or extendable lease term not less than 12 years. So 12 years remains the same. Accruing or arising from transaction, whether by becoming a member or acquiring shares in a cooperative society, company or association of persons or by virtue of an agreement or arrangement, whatever name called, not being a transaction by way of sale, exchange or lease as effect of enabling agent. So 269 UA reference they didn't give, instead they explain. So remains the same. So here we close income from house property. That is same. Now income from other sources also, no change. Number of sections remain the same here, luckily. But the number, I mean in between many things has happened because after salary, house property, then we have capital gains, business chapter and then comes other sources. So many things has happened in those two chapters. That's why suddenly from 56 it became, if you see a house property we became like 22 became 20, whereas here 56 became 92. So you have to wait and see. I think many explanations, professors, all those would have become subsections and sections in that, all those big chapters, capital gains and business. See, the heads, the heads of the section remain the same. Section 56, income from other sources, here it is section 92. So we had in the existing Act section 92 transfer pricing provisions. Now 92 is only other sources. Section 57, deductions, here it is 93. Amounts not deductible, section 58 became section 94. And profits chargeable to tax, similar to our deemed income, section 41. We have section 41 in the existing Act. Same way, this is now section 38, that balancing charge and all those things will come. The cessation of trade liability. If it is not taxable under business, it is taxable under other sources. Same. Definition. Here, main thing, all those 56 that just somebody on the 620, that's why. The gift provisions, the gifting of immovable property, then all those provisions remain the same. Relative definition remains the same. No change. Any income by way of so there is a 15 minutes break now.
Snacks is availability at fourth floor. I request all the members to kindly reassemble after 15 minutes.
So this salary, we were discussing salary just for warm up. Salary when we were discussing, we were referring to section 124, if you remember. That time I was not. Sorry. So when we were discussing salaries, we were referring to section 124. The fund referred to, pension fund referred to in section 124, it was coming. It is similar to our 80CCD, that pension scheme. So this is that section, the contribution to pension under the scheme of the central government. So I was just referring 124 is section 124 is similar to the contribution of pension scheme of central government under section 80CCD, the present act, and 125 is that Agnipath scheme.
So this is NPS.
NPS basically.
NPS.
Okay, so fast we can finish up. There is not much change. Our session is up to 8, no? I thought 7. Okay, so income from other sources, same thing. Whatever principles we have learned, whatever income not taxed under other specific heads of income is basically taxed under other sources. And in addition to that, there are certain specific categories of income like dividend, interest, etc. is also taxed under other sources. Income of every kind which is not to be excluded from the total income. So basically, which is taxable income shall be chargeable to tax under the head income from other sources if it is not chargeable to tax under any of the heads specified in section 13. So if you remember at the beginning of the session, we started heads of income in the present act is section 14, in the new act it is section 13. So if it is not falling within A to B, that means salary, house property, capital gains and business chapter, then it will fall under other sources. This is all along our understanding since there is we started reading Income Tax Act. In particular, and without prejudice to the generality of the provisions of subsection 1, the following income shall be chargeable to income tax under the head income from other sources. Any dividend, winnings from lotteries. So I think I don't know. At least in my experience, I have not read this income from other sources chapter for a long time in my life, because we know interest, dividend. Other than special categories of income, if you come only will get it out, or we get it out on taxability of you for maybe somebody getting a what you call your property beyond fair market value. All those situations we read sections. So we just go through what are the categories of income which is being taxed under this chapter, this head. Winnings from lotteries, crossword puzzles, races including horse races, card games and other games of any sort. So all the games, gambling income will come under other sources. Any sum received by the assessee from employees as contributions to any provident fund, superannuation fund or any fund set up by ESI Act or any other fund for the welfare of such employees, if the income is not chargeable to income tax under their profits and gains of business or profession. This I have not practically come across this. So basically, if it is taxable under business head, it is other than that, if somebody receives here, then it is taxed under other sources. Any sum received under key man insurance policy as defined in section schedule 2 is in schedule 2 and note C. So here now I have schedule 2. So this is schedule 2. So it has a table with all the categories of deductions. And if you see, this is schedule 2, and this is how a schedule comes. Okay, every schedule will have notes. Those notes are very critical, and they will refer to a particular note number under a particular schedule in some section. So here you see here they have referred to schedule 2, note 1. Okay. For key man insurance policy as defined. So the definition of key man insurance policy, earlier we used to get for the purpose of this section key man insurance policy, you would have defined there. Now it is not like that. Wherever that key man insurance policy we have to go to schedule 2. So schedule 2, if you see basically what is schedule 2? Section 19. If you see schedule 2, see here, income, schedule 2 is talking about income which does not form part of total income. Basically your chapter 10, chapter 10, exempt incomes. Okay. Now this whole schedule 2 is out of that. In that we found reference of some serial numbers in salary chapter. Schedule 2, item number 3, item number 8. Then here they are referring to, now this is a schedule, just to be familiar. And under the schedule there are notes. And under note 1, note 2, like that, if you see schedule 2, there are, let us see, note 1 has all the subclauses, note 2, note 3, note 4, note 4. 4 notes are there under schedule 2. So he is saying under note 1, here they have defined capital sum assured, International Financial Service Center, and note, if you see C, if you see here C, this is the definition of a key man insurance policy. So the definition of key man insurance policy is in schedule 2, note 1, clause C. That is what he is referring here. Any sum received under key man insurance policy as defined in schedule 2, note 1, including bonus allocated on such policy, if such income is not chargeable to tax under their business or salaries. So it is a part of employment, that basic principle. It is not taxed under any of those chapters, then it is taxed under income from other sources. So these are same thing we had. We will go through that existing section also after this. Any income by way of interest on securities, you are familiar, if it is not taxed under business chapter. Any income from machinery, plant or furniture belonging to the assessee and later on hire. Belonging to the assessee. Actually not, we are not talking about ownership here. Belonging to the assessee and later on hire, and if the income is not charged to tax under business. Any income from letting on hire of machinery, plant or furniture belonging to the assessee, and also buildings where letting of building is inseparable from the letting of such machinery, plant or furniture, if the income is not charged to income tax under their business. Existing provision. Any sum of money received as advance or otherwise, this is important. Any money forfeited, for forfeiture of that advance amount for transfer of capital. Earlier, before amendment, existing existing act also amended. We used to adjust it against cost. Then they amended it. Any sum of money received as an advance or otherwise during negotiations for the transfer of a capital asset, if such sum is forfeited and the negotiations do not result in the transfer of such asset, is taxed under other sources. We might come across practically some situations. Any income by way of interest received on compensation or enhanced compensation referred to in section 278. Now what is section 278? Let us see. 278
Compulsory
is
acquisition.
compulsory acquisition.
Compulsory acquisition.
278 taxability of certain income. That's all. 145B. 145B. We'll go to that. No. Any interest received by an assessee on any compensation or on any enhanced compensation shall be deemed to be income of the tax year in which it is received, irrespective of anything to the contrary contained in section 276, taxability of certain income. So basically any interest on any compensation is taxed under this chapter. Okay. So coming under business chapter only. 277 and all is method of accounting. We had 145, now it is 277. Coming back, any compensation or other payment due to or received by any person by whatever name called in connection with the termination of his employment or the modification of his terms and conditions. So here, at the point of termination, profits will be of salary. Now, after some years, there is nothing, after some 5 years or 10 years, nothing to do with employment, then it can be taxed under other sources. But so far, in my experience, we have done it under salary only, but here is a place. Any compensation or other payment due to or received by any person by whatever name called in connection with the termination of his employment or modification of his terms and conditions. It can be taxed under other sources also. Any specified sum received by a unit holder from a business trust. Same thing, actually we have in the existing act also. In the tax, during the tax year, with respect to a unit held by him at any time during such tax year, the computation, specified sum is computed. The manner of computing the taxable income is given here. Aggregate of the sum distributed by the business trust, and from there we have to deduct whatever amount at which the unit was issued and the amount charged to tax. All those are the deductions, and final that net amount is taxable as income from other sources with the hands of the unit holder. Any sum including bonus allocated is received during a tax year under a life insurance policy other than sums received under ULIP. So this was a catch. Earlier ULIP was under 10, then they removed, then they brought it under other sources other than ULIP. Now ULIP is under capital gains. Income referred to in clause B. Such sum is not to be excluded from the total income of that tax year under schedule 2. See, they are referring to again schedule 2 table serial number 2 the sum exceeding the aggregate of the premium paid during the term of such life insurance policy and not claimed as a deduction under this act computed in such manner as may be prescribed. So basically the 10-day exemption depending upon the year of the policy, the maturity process will be taxable, and whatever premium paid we can claim as a deduction, and the taxation, that's what they are saying, of the policies other than ULIP. ULIP is now under capital gains. Where any person receives in any tax year from any person, so here is the case gift and all will come. Any sum of money without consideration, the total of which exceeds 50,000, the amount remains the same. The whole of such sum, any movable property without consideration, the stamp duty value exceeds 50,000, the stamp duty value of such property. For a consideration, the stamp duty value of such property exceeds such consideration if this excess is, amount is more than the higher of the following: 50,000, 10% of the consideration. For any property other than immovable property, without consideration, the aggregate FMV of which exceeds 50,000, the whole of such aggregate FMV. Then for a consideration which is less than, so immovable property, so any sum of money is coming here, immovable property is coming here, any property other than immovable property. Same like the existing act. Provisions of 2M shall not apply. So it is exclusion for the previous section. If it is from any relative, we know this. On the occasion of marriage of individual under will or by way of inheritance, in contemplation of the death of the payer or the donor, or from any local authority, or from a registered NPO as defined under section. So these 355 chiller, all the sections are the existing section 11, section 12. So now in the new act, that whole section 11, section 12, section 13, which were applicable for not-for-profit organizations, is now a new chapter. There is a specific chapter exclusively for those category of organizations. Of course, it's not a part of this session, but just I thought since we came across that, principles remain the same. Broadly, I can say that condition to spend 85%, accrual, accumulation, audit, all those things remain the same, but it is a separate chapter. So that is why section 355 became any NPO with approval under section 12, that is 355G, except when the person, it is received by a person referred to in 355H. So 355H is nothing but the specified person. If you see section 13.3 of the existing act, there is specified person, author of the trust, then any concern in which the author is interested, any substantial contributor who has contributed more than 1 lakh, specified person is there now. This 355H is similar to that. It's the same section. Then, by way of a transaction, so basically if anybody gets any help, any money from trust which is it's a charitable trust, it is not taxed as income in the hands of the recipient. The whole purpose is that only, right? Then, by way of a transaction not regarded as transfer, this to my mind section, transaction not regarded as section 47 is transfer, transaction not regarded as transfer, I think now it is section 70, capital means chapter. Then, from an individual by a trust created, this is a private trust. It is received, money or property received from an individual by a trust created and established solely for the benefit of the relative of the individual. So, if the individual transfers some money to a trust, it's a private trust. When I say private trust, the general public is not the beneficiary. Specified children or minor children or whoever is the beneficiary, then that it is not taxed as income in the hands of the trust. Then, from such class of persons subject to such conditions as may be prescribed, any local authority has defined under. So here he is referring to Schedule 3. Now we have to see Schedule 3, Note 6. Let us see. We will also see 498. 500 is Schedule 2, I think. This is Schedule 2. So down it should be Schedule 3. What does it mean? Schedule 3. So income not to be included in the total income of eligible person. So now you see, the first Schedule 2 we saw income not to form part of total income. Here some specified categories of people they are bringing in. Income not to be included in the total income of eligible persons. And income not to be included in the total income of individual who is a member of HUF. Then legal hair. Now, so he is referring to Note 6 of Schedule 3. So this is Schedule 3. In this we should go to Note 6. Our student days are back. Note 6. It's a great leveler, there is no senior, junior and all in CA office anymore. That way if you take a look at it, it is good. Note 6, all of us can read together. For the purpose of serial number 22, the expression this is basically definition of local authority. That's what he meant here. Okay. Okay. Next, if the date of agreement. Okay. So here we have something. Previous slide. From an individual of address from such class of persons and subject to conditions as may be prescribed. Then, for the purpose of section 2M2, the date of agreement fixing the amount of consideration for the transfer of movable property. So here 2M2 is basically that fair market value. We will compare the value if you receive without consideration, the compared with the fair market value, and they give a margin of error. So that's what. If the date of agreement fixing the amount of consideration for the transfer of movable property and the date of registration are not the same, the stamp duty value on the date of agreement shall apply provided the consideration in whole or in part has been paid in specific banking or online mode as defined in section 6632 or not before the date of agreement of transfer of such property. If the stamp duty value of movable property is disputed by the assessee on the grounds mentioned in 78.2, the assessing officer may refer the valuation of the property to the valuation officer. The provisions of section 78 and section 288(1) tabled serial number 8 shall as far as may be applied to the stamp duty value of such property as may be for valuation of capital asset and those considerations. So this is the case where Somebody gives a property and we consider the fair market value, and for the valuation, these principles remain the same as in the existing act.
Which is the table here?
Huh?
Table.
Table serial number 8.
What table it is?
Yeah, well, let us see. Table serial number 8. 782 and 2881. Table serial number 2. This is 92.4, right? M 2M2. Table serial number 8 only they have told. So there should be a table 78 or 2881. Provisions of section 2881 table 2881 section 2881. Let us try. This case. The assessing officer may carry out such actions as are specified in column B of table below for reasons mentioned there is subject to the conditions specified in column C within 4 years referred to in section 287(8), which shall be reckoned from the time specified in column B. Questions of 287 shall apply. So basically amendment to the order of the assessment. So 288 is which the corresponding section here. You will be able to understand. Other amendments, section 155 of the existing act, sir. You know what is section 155, let me read for the first time in my life. What is 155?
Guidelines.
Other amendments. After tested, before tested and assessment. What context? It's all assessment chapter.
Time limits.
The similar provision they will discuss on there. That's it. Other amendments, where in respect of a completed assessment, time limits. In what context we can bring amendments to the big section? Amendment to the order of assessment. Within what time you can bring amendments? So here he is referring to serial number 10. The order of assessment to be amended to compute the capital gain by taking the full value of consideration to the value as so revised in appeal or revision or reference. Wherein the assessment of a capital gain arising from the transfer of a capital asset being land or building or both is computed by taking the full value of consideration received or accruing as a result of the transfer to be the value adopted or assessed by any authority of a state government for the purpose of payment of stamp duty as per section 78(1), and subsequently such value is revised in any appeal or revision or reference referred to in section 78(2)(b). Then what is the timeline from the end of the... So basically this is what he is referring there. What are revising was passed in appeal. So here why he is referring refer the valuation for that stamp duty. Section serial number 8. Subsequent revision in the stamp duty value. So that revised value have to be considered. But that is basically what he is saying here. See, if it is referred to a valuation officer, that revised value has to be considered for computing the income taxable under the other sources. Then, 90(5) for the purpose of this section, assessable means, card gain means, fair market value means, jewelry means, lottery means, all these definitions are coming here. What is property? All those are brought in by way of 90(5). relative, same definition remains the same. Individual, spouse, brother or sister of the spouse, brother or sister of either of the parents, lineal ascendant, lineal descendant, HF any member, the unit life insurance policy in Schedule 2 Note 1, where they have defined Note 1, they defined key man insurance, there they have defined UNIP also. I am interested, before going here, let us see, to the best of my knowledge, there is no definition change for relative. So this is the existing 56. So whatever we read through, this is across 56-2 actually, basically. So here, if you see existing 56.2, they draw reference to section 2 subsection 24. Any income referred to in section 2 subsection 24, the relevant clause they will bring in. That is how we read section 56.2 in the existing act. See, in particular and without prejudice to the generality of the provisions of subsection 1, the following income shall be chargeable to tax under the head income from other sources dividend. Income referred to in subsection 224.8. Then income from section 224.9. So they draw attention to the income definition under the existing act. Then here, income from business or profession, any money exceeding 20,000 rupees required from Hindu undivided family, then from any relative on location of marriage of individual under a will or same thing. Whatever we read here is reproduced across various sections. Here, definition of relative I wanted to see.
56.7.
Yeah.
Subclause
Here only it is there.
clause 7.
And this one it is there here. So it is by way of an explanation in the existing act. For the purpose of this clause, relative means spouse of the individual, brother or sister of the individual, brother or sister of the spouse of the individual, brother or sister of either of parents of the individual, any lineal or descendant of the individual. Here they told maternal or paternal in the new definition. Any lineal ascendant, so in the existing act, it is just mentioned any lineal ascendant or descendant of the individual. Here they clarified any lineal ascendant, maternal as well as paternal or descendant, same thing, of the spouse. Then what else they made? Spouse of the person referred to 2 to 5, where any sum of money, the aggregate of which exceeds 50,000 rupees is received without consideration by an individual or HUF in any previous year from any person or persons on or after 1st day of April 2006 but before 2009. So here we know that clauses have some timeline. If you see 56, certain things are applicable only up to certain financial years. Then they brought in another clause. Before that, the definition of the relative definition was different. That's the whole thing is there in the existing act. So all those redundant things they have removed in the new definition. In the existing act, there was a definition of relative which was relevant for financial year between 2009 to 2017, 2006 to 2009. 1st April 2006 to 1st day of October 2009, there was a set of definitions applicable for individual relatives. I don't think that is there in this the new act. Before going for deductions, I wanted to that's all. Most of these are same, relative, persons, drilling and change, letting of building. So here, if you see here, dividends, then 224.8 that contribution from the employee, if the employer doesn't pay, it becomes taxable in his hands. Then interest on securities, letting of machinery, plant or furniture. Then plant or furniture form part of the building. Then 224.11 if such income is not. So business chapter, if it is not 2 subsection, again income definition they are referring to. which is not taxable under salaries means it is taxable under the heading to from other sources. Any sum of money exceeding 25,000 rupees without control. So 25,000 rupees later they made it as 50,000. That is, in the new act also they have made it 50,000. Then whatever money received other than from a relative, exclusions are the same. From relative on the occasion of marriage, under will or by way of inheritance, in contemplation of the death of the payer, any local authority. Then any fund, this one, any fund, foundation or institution approved under section 1023C, or any trust or institution referred to it under section, approved under section 12A or 12AB. Same. I didn't find anything new here. Then come deductions. Deductions. For dividends excluding, so 240F, that is similar to 222E, or interest on securities, any reasonable sum paid as commission or remuneration to a banker or any other person for the purpose of realizing such dividend or interest on behalf of the assessor. So basic principle is any expenditure earned to earn the income has to be claimed as a deduction. That principle is remain the same. For the income referred to, in the nature referred to in 92.2c. So 92.2c is, we'll see. C. Any sum received by the assessee from employee as contribution to provident fund, superannuation fund, or any fund set up by ESI or any other fund for the welfare of such employees, if sum is not chargeable to tax under business. So if any category is not falling under business and if they incur any expenses to earn this income, then that is allowed as a deduction, is what he says here. So far as maybe an amount as per section 29(1). 29(1)E is income from business, manner of computing profits, and so it's actually computation similar to section 27. Section 29 is income from profits and gains of business or profession. Sorry, 29 is, I tell you. Deductions related to employee welfare. Like we have other deductions in the existing act, right? Section 36 and 48 deductions, expenses and payments not deducted. So that disallowances and other deductions, that is similar to section 29(1). So 36 is all your employee contribution, that PF contribution, all those things under section 36. Within, if we don't pay within the due date as per the Employee Provident Fund Act, it is not claimed as a deduction. So that is what I am referring here. 29 is equal to section 36 of the existing act. For the income of the nature referred to in 92 to F and G, so far as may be an amount as per section 28(1) A, B, C, E of section 33 and subject to provisions of section 28. So section 28 in the new act is rent, rates, repairs and insurance. Something similar to section 30, section 31 and section 38 of the existing act. So all these are, they are drawing attention to the business chapter. Family pension, the rules remain the same. Any income in the nature of family pension, regular monthly amount. So he has defined family pension here. A regular monthly amount payable by the employer to a family member of an employee upon the death of such employee, and an amount equal to 1/3 of such income or 25,000 whichever is less, and where income tax is computed under section 2021. And amount. So this is the standard deduction from family pension. Then, any other expenditure not being in the nature of capital expenditure laid out expense wholly and exclusive for making or earning such income. So, this is a general principle. Like section 37 we have under business chapter. Any expenditure is not in the nature of capital expenditure, we can claim as a reduction. Like that, even similar to our section 57. Any expenditure not in the nature of personal expenditure or any expenditure not in the nature of capital expenditure, we can claim as a reduction against the income. So, this is a blanket provision. For income of the nature referred to in section 92I, an amount equal to 50% of such income and no other reduction shall be allowed in this section. So 92I is actually, I will tell you. Any income by way of interest received on compensation or enhanced compensation referred to in section 278. If you have an income in that nature, then 50%. So if the nature of compensation falls within the definition of section 278, then an amount equal to 50%, it's like a standard deduction. If you have any compensation falling within the definition of section 278 and which is taxed under section 92I, then 50% of that is allowed as a standard deduction. Then for income in the nature of commutation of pension received from a fund. So this is a pension which is not coming as a part of the employment. So if somebody gets a pension from PF or whatever contribution the employer has made, and from there the person gets a pension after retirement, it is taxed under salaries, and the principles of commutation will apply as per the provisions of salary chapter. Whereas if somebody does a contribution to a pension fund, third party, now we have no LIC, all those pension fund not as a part of the employment, and they get an annuity pension either in commuted or there are options, then that pension is being discussed here, which is taxed under other sources.
So NPS pension is taxable, right?
So NPS pension, that employer contributing category, that pension.
Not employer-employee.
There are rules, sir, because depending upon the schemes, for example 60% if you take commuted and non-commuted. Basic principle is any pension which is non-commuted is taxable, there is no exemption. Commuted pension only subject to some conditions it is taxable and it is exempt. Whatever you get monthly, no, it is taxable, even in NPS. For income in the nature of gratuity as referred to in section 192G received on the death of the employee, the entire amount. So these are deductions. Again, this is 192G may not be the gratuity what the employer gets. This should be the 192G. We will see what it is. I think it is received by the spouse. It may not be the death retirement gratuity of the employee because it will not come under other sources. So 192G section talks about gratuity, but this is the death. After the death of the employee, definitely it goes to the family member. So it will not come as a salary income. It's like family pension. Dividend income referred to in section 240F. No reduction shall be allowed. So these are different categories of dividend. See, what happens is, if earlier we had a provision where the dividend is exempt, then whatever expenses earned to earn that exempt dividend is not allowed as a deduction. So now 2 subsection 40F, that definition, what dividend he is referring to, in that section we should see. We will see that. Then we can understand what dividend he is referring to.
22B.
It is similar to the deemed dividend. So 240F. Similar to dividend. It may not be the dividend from investments. That's why it's not allowed in deduction. Dividend. So 240 is at par with 2 subsection 22. Now 240F we should see. I will try to read from here, that will be faster. is definition of dividend. Clause F talks about any payment by a company, it's buyback I think, any payment by a company on purchase of its own shares from a shareholder as per section 68 of the Companies Act. So it's like that buyback. 240F talks about any payment by a company on purchase of its own shares from a shareholder as per section 68 of the Companies Act. So any dividend income of the nature of 240F, no deduction shall be allowed under other sources. Buyback, we will have a separate chapter. In the existing act, there is a separate chapter for buyback, so it may not come under other sources. That is why he is not allowing to claim any deduction. Otherwise, also here, see basically what happened in buyback, existing provision they amended. No, first it was under capital gains. Now that cost is allowed as a carry forward loss, and buyback on gross basis is taxable. Yeah. Any other dividend income other than clause A or income from units of a mutual fund under schedule 7 table. So this schedule 7 has, we discuss about something similar to our 1023D. I will show you that. Income from units of a specified company as referred to in 2H of the UTI. Only deduction shall be interest expense, which for any tax year shall be included 20% of such income, included in the total income of that year without deduction under section. So this is, to my mind, this applicability will be very less because that UTA income is more or less gone. Very rare people have UTA income now. So this, according to me, this particular provision is redundant. But for our understanding, we can see schedule 7. So schedule 7, it's all UTA dividend. Schedule 6 is again income to be not to be included in the total income of eligible non-residents, foreign companies and such other persons. All our 115 category comes in schedule 6. And schedule 7, schedule 7. Not sure I will see schedule 7. Person exempt from tax. Any eligible person mentioned in column B of the table below shall not be liable to pay income tax on total income of the tax year, subject to the conditions mentioned in column C of the said table. The expression used in column B and C of the said table shall have the meanings respectively assigned to them in the notes below of the said table. So some special funds are discussed here. Regiment fund. So here he is referring to units of a mutual fund specified in schedule 7. Table serial number 20 or 21. Let us see. So all the funds are mentioned here. The existing act only I have not seen this. See. A mutual fund registered under SEBI. Similar to our 1023D. Then a mutual fund set up by public sector bank or a public finance institution authorized by RBI. Or I think your HDFC mutual fund and all may come here. Only deduction. So this is what or income. So any other dividend income other than this dividend, because the regular dividend will be taxed as dividend income. For any other dividend, in respect of any other dividend and UTI, all this category he is telling in respect of this dividend what is allowed as a deduction, only 20% is allowed as a deduction is what he says. If you come across any such things, be aware of this. I have never come across any UTI dividend so far. But there is a standard deduction allowed. Then 94(1). Irrespective of anything contained in section 93, the following amount shall not be deductible in company income of the assessee chargeable under the other sources. Personal expense, interest chargeable under this act payable outside India if no tax has been deducted at source, and any payment chargeable under the head salaries if it is payable outside India unless the tax has been deducted at source, similar to the existing provision. The provisions of section 29, 35B1 and 36 shall apply in computing the income chargeable under the head income from other sources as they apply in computing. This is all similar to TDS disallowances, then cash payment in excess of 10,000, all those whatever provisions apply under the business chapter is applicable here. I have not fully read business chapter, so if we want, maybe we can read now. Section 29 of the business, section 29. Since we are here, we will at least get familiar with that section. What is section 29? Deductions related to employee welfare, we already read it. Then section 29, 35B, 35 is similar to amounts not deductible in certain. It is equal to section 40, all the disallowances. Under the existing business chapter, all the disallowances come under 40 subclause A, the TDS disallowances, 40A to B, all 40A3, all those disallowances. So section 35 is equal to disallowances. Okay. So same thing, that whatever principle, if the income is taxable under business head, we will apply section 40 disallowances. If the income is taxable under other sources, all those principles apply mutatis mutandis. That's all you see. For an assessee being a foreign company, the provisions of section 59 shall apply in computing the income chargeable under the head income from other sources as they apply in computing the income chargeable under the head profits and gains of business or profession. Section 59. 59 is computation of royalty and fees for technical services. So 44DA, similar to section 44DA. That's why foreign company is coming here. Then section 94(4). In computing the income from winnings from lotteries, cross purposes, races including horse races, card games and other games of insult from gambling or betting of any form of nature, no deduction of any expenditure or allowance related to such income shall be allowed, because nobody incurs any expenditure to earn that income. It's a game. It's all similar. Subsection 4 shall not apply in computing the income of the assessee being the owner of horses maintained for running in horse races from activity of owning and maintaining. So this expenditure of maintaining horse is not the expenditure incurred to earn win. So whatever money comes from winning is a separate tax on gross basis, but if he earns income by sending the horse on hire, then whatever expenses he incurred to maintain the horse can be claimed as a deduction. For the purpose of this section, the expression horse race means horse race upon which a getting or winning may be allowed to be. Same thing. Then this is similar to section 41. Section 38 is similar to section 41. We have section 30, that is cessation of trade liability, then balance in charge, all those incomes which is taxed as deemed income under section 41. Same thing, if it is not taxed under business side, it is coming under other sources. So any write-off of this liability is taxed as income. Same thing they are saying. The provisions of section 38, 1, 2, 3, 4 shall apply in computing the income of the assessee under section 28 as they apply in computing the income of the assessee under section under the profits and gains of business or profession. Section 38 to my mind is equal to section 41 of the existing act. Yes. Certain deductions allowed on certain sums deemed as profits and gains of business or profession equal to section 41 of the existing act. So same principles apply. That's all from other sources. So other sources, see, the familiarity is the question. See, many of the things, at least in my day-to-day practice, I have not come across many categories of income, as I told you. But basic comparison I did, and I find there is no change. So this Excel sheet I share with you, it is a bit longer thing. They refer to so much sub-clauses in the existing, our existing 56 itself is complicated, as you know. So basically, I can say that broadly, there are no changes between the existing provisions of income from other sources and the amended ones. Now, practically when we come across, we should see in this, see one thing, as I told you, we have to get familiar with this new act. Because other sources, what I thought is, as you saw, many things are referring to the existing section. So either we should refer to business chapter, or we should refer to definition sections, or they are drawing reference to even salary chapter. So I think familiarity is the key for appreciating the provisions of income from other sources. So here, comparison wise, 56 and 92 are similar. Then 92.3 definition of relative is as per section 36.2 only. Then 90.4, so 90.4 is the registration. So 90.4, if you see, is similar to our same thing, 56 only. So don't think he brought in any change over there. That's all from me as far as these three incomes are concerned. If anyone has any questions or anybody wants to share, if you have come across any, I'm very honest, I tried my best to do a comparison. There are chances that I might have missed because I am also as new as you to this new act. So if anyone has in this August gathering, if anyone has identified some difference or anything, if you have, you are most welcome to share it for the benefit of the people here. Yes.
Any amount to account of marriage is exempted. What about if received by attendee?
Attendee also got married. Return gift is taxable, sir.
Section is very clear. It says
At the time of marriage, whoever receives is exempt. Is your interpretation, sir? Actually, it's a very good question.
marriage of individual. It is very
So, if one person is getting married, in that individual, whoever participates, whoever gets money should be exempt.
Yes.
I wish. Yeah, so I think people will take it as a mode of making income. I think, offline, pay comply situation, we can apply this. But that's a very good thought process. I really appreciate it, sir. Never I got a doubt. See, this is wonder. This is wonder. I wish Nirmala Sitharaman ma'am doesn't hear this. She will make one amendment. For the purpose of this section, marriage of individual means only the person who is getting married. But who gives return gift more than 50,000, sir?
account of marriage. It is exempted. So
Ambani will go for specific exemption certificate. But wonderful thought process. I never got a doubt only in that. Brilliant. Yes.
How many days it took for you to make this comparison?
This weekend, sir. Saturday, Sunday. Because up to that 10th was there, no, sir. We never got. I seriously didn't get time to do it. This actually, my idea was comparison, but then I thought that presentability is a question. With this only I read it, sir. Actually, to be very honest, income from other sources, so much detail I have never read in my life. Even at the time of CA final preparation also. But every time we get a doubt of similar nature, like unaccounted money, it is a gift taxable. Most of the question is based on that only. And especially trust. See, we had situation where one trust was there. It was an interesting thing. It is not relating to this act. It is a practical experience where the trust got registered. And one set of people contributed almost, it was a trust created to educate women. And the trustees contributed close to some 6 or 7 lakhs, and they applied for 12A, but by the end of the financial year and before the due date for filing the return, they never got approval. So the whole thing we were thinking 12A approval will come and it will be exempt, but what to do with that money? They can't return also. So first financial year we treated it as a loan, and I'm saying such practical scenarios I have read, and also when there were angel tax provisions we have read. So other than that, but as I told, it's a leveler. We can go back and read all the
Have you read other chapters also?
Yeah, some this trust chapter I read, sir, because we have not-for-profit organizations and things. So I had a session on that.
Trust also.
Yeah, so trust basically is a new. See, as you know, the existing provisions of Section 11 for the benefit of the thing. Basic sections are Section 11. The property of the trust, and any amount received in a financial year, 85% of the amount has to be applied for charitable purposes, and 15% can be kept as accumulation. Accumulation says no need to spend. Now, other provision is if the trust is not able to apply in the year of receipt, there are two sections basically in the existing Form 9A and Form 10. One does Form 9A, it should be spent within the next financial year. Form 10 talks about accumulation for a specific project within next 5 financial years. Actually, by 5th financial year, it has to be utilized for the specific purpose. All this remains the same. And then what they say is downstream donations. Downstream donation means one organization having 12A approval is simply passing through the money. They received 100 rupees and they give 100 rupees to another organization without applying for a specific object of the trust. Then only 85% will be allowed as application. That provision remains the same. Then specified party, specified persons, author of the trust, any concern in which author is interested, any substantial contributor, all those provisions remain the same. One interesting thing which the way they have this by removing the proviso, like for example, if you know the existing charitable purpose definition has 6 links: relief of the poor, education, medical relief, preservation of environment, preservation of wildlife, yoga, and any object of general public utility. And in this last link, there is a proviso where they say if more than 20% of the gross receipts if they get in the nature of commercial receipt, then 12A approval is at stake. Now the way they have brought in the definition of charitable purpose, this 20%, some people interpret it like that, like as if there is a loophole to escape, the way they have presented, but very unlikely you will have a provision to escape that. Otherwise, all other conditions remain the same. My basic reading, the need to get accounts audited, then amendments, any amendments to the trust deed needs prior approval of the income tax officer, then renewal of every 5 years. Only they have to spend for the activity for which they have been incorporated. All remain the same, only thing they brought in like a separate chapter. Otherwise, there is no much change as far as the not-for-profit entities are concerned. Then other than that, I didn't read much chapter. Then some definitions. Actually, we read the first one. First they released one draft somewhere in February. That we read. Then the suggestions were given. It was an experience where they took the suggestions, and this latest one which she came up with in August 13th, right? That one I am to read actually. This is the first thing I read in detail.
And for gift they have said marriage of the individual. So already they have ring-fenced that one. So we cannot.
See, we all understood in that, sir, but sir has created a thought process. Only for that individual, in the hands of the individual when he gets
the
married.
hands of the individual, it is exempt on the marriage of the individual. Already it is.
It's actually connected. There is it's an event. An individual is there. When that income is exempt, one of the event is when he gets married. Now another question. Like on a lighter weight, there is no limit on the number of marriages.
For second marriage also, if he gets,
how many? So that is marriage of convenience can happen.
And this one financial year and tax year, what is the difference?
So there is no assessment year, sir. No, like a GST. Like whatever year in which the income is earned, it is getting taxed as tax year. There is no income of this year is being taxed in the next year. It is not there. That is the
Financial year and tax year.
Same. Financial year and tax year is the same. There is no assessment year.
No, I understand. Now, financial year and tax year, we have two separate definitions.
No. Tax year only they have defined is financial year. Say I will read the definition. That's a good question.
There is no assessment.
It is actually at par with that DTAAs and all. When you read DTAA, there is no question of assessment here, no, sir. They have tried to be at par with the DTAAs, is what I thought. I don't know what they achieved by that, but no. We are yet to see the implications. But I think the real challenge is for those who are in litigation. Another 10 years they have to carry the existing act and side by side. It's going to be tough. We need a lot of energy. Tax means income taxable and tax officer. Tax year, actually tax year is not defined. They define year, I think. It's the same as financial year. See, definition of tax year. For the purpose of this act, tax year means 12 months period of the financial year commencing on 1st April. That's all. In the case of business or profession, just like we have here, profession newly set up or a source of income newly coming into existence in any financial year, the tax year shall be the period beginning with the date of setting up of such business or profession, or the date on which such source of income newly coming into existence and ending with the said financial year. So basically, they told that 12 months period of the financial year commencing from 1st April.
Financial year also we have a definition.
I don't think so. I think any 12 months is a financial year they have told. Let us see. Financially we have to go for General Clauses Act, sir. I am not find it. I remember in our study circle this doubt came, and we came to the conclusion that I think under General Clauses Act, financial year is defined. Yes. Anything not defined, you have to go to General Clauses Act. Then first we should start reading definitions. But it may not be as hard as GST. When GST came, it was too hard for all of us, right? It is not that difficult. We can catch up. We are trained to do that. I don't know, capital gains chapter and all. To my mind, when we read the first draft, there was no big change, but there were some critical changes. I don't remember now. And anyway, that we have to unlearn because the new one I have not read. But when we did comparison, there was we actually line by line we read. Some sections were allocated to our Directs Committee of KSE, and we including lot of spelling corrections or even by putting in the wrong place if and but the meaning changed. Capital gains chapter and all there were many things.
So the major changes are in the capital gains.
Capital gains, yes. Can't say like that, ma'am. Actually, I can say there are not much changes in heads of income. I think TP provisions, some changes are there. Oh no, actually, I can't talk. Maybe I don't know. We'll see. That structure overview will be a super session. That impact of, actually that was the first doubt. What is the impact of removing something as proviso and bringing it as a section? What is the long-term impact? In fact, when we were reading, we found that there could be, because of that, there could be a chance that somebody will even claim a short-term capital asset as a long-term capital asset. There is a likelihood of the way you read by removing, by changing the proviso to a subsection. What is the impact? And somebody was telling, by replacing notwithstanding with irrespective, in fact, it is going to be more litigative. The interpretation of the word irrespective. So, we have to see, sir. So, if there is no questions, thank you very much. I thank all the I was thinking salary, house property, other sources. Maybe after signing the attendance, people will go. So, I'm really thankful to Bangalore branch because, as I told you, I wouldn't have opened this book so seriously unless there was a session. In every session, I strongly believe the first beneficiary is speaker. So I sincerely thank each and every one of you and also the Bangalore branch for giving me this opportunity. Thank you.
Sorry for the delay. Good evening, members. So we have the most happening event, that is GCC Summit in the month of December 12th and 13th. I request everybody to register for that event because it is one of the special events which is only happened in 4 locations in the entire India. So please make use of it. The most buzzword GCC, you will get to know a lot of things. And thank you so much for the speaker on briefing this new income tax session on salary, house property, and other sources of income. So we'll meet again next week in the study circle. Thank you so much. Sorry. So I request the chairman of Bangalore branch, CA Manjunath M. Hallu, to present a small token of appreciation to the speaker. Thank you so much. Happy evening.